You know, sometimes the oldest tools in the toolbox are the ones that pack the biggest punch. Today, we're going to talk about one of those. It's called the Donchian Channel, and it's been around for over 60 years. Created way back in the 60s by a true legend in trend trading. On the surface, it looks incredibly simple, but, and this is the really cool part, it's got a modern twist that is, well, it's pretty surprising.
All right, so here's what we've got on tap. First, we'll get to know the legacy of the guy who created it. Then we'll break down how to actually read the channel itself. After that, we'll cover the classic strategy it was built for, and then the surprise twist that makes it so relevant today. And finally, we'll tie it all together so you can see how it works in practice. Let's get into it.
So first things first, let's talk about the creator, Richard Donchian. This guy is a legend. Seriously, they call him the father of trend following for a reason. He was one of the first to really get into quantitative analysis, and his whole philosophy was, forget chasing tiny little profits. The real money, he believed, was in catching those huge, directional waves in the market.
And this quote right here, it pretty much sums up his entire approach. The Donchian Channel wasn't just some random indicator. It was designed with a single purpose, to give traders a crystal clear, almost mechanical signal for when a big move was just getting started. It was all about getting in early and just riding that trend for everything it had.
Okay, so what exactly is this thing? Well, at its heart, it's a super simple visual tool. Seriously, that's its genius. It just draws two lines on your charts. The top line? That's the highest high the price has hit over a certain period. And the bottom line? You guessed it, the lowest low. That's it. It creates a channel around the price. And how you calculate it is just as easy. There's no crazy math here, no standard deviations, none of that stuff. You literally just take the highest high for the upper band, the lowest low for the lower band. And that middle line? It's just the average of those two. Simple as that. The elegance is in its simplicity. All right, so now that we know what it is and how it's made, let's get to the fun part, how to actually read this channel. Because these three simple lines, they can tell you a whole lot about what the market is thinking and feeling.
A great way to think about it is like a river. The bands are the riverbanks. When those bands get really wide, the river's flooding, right? That's high volatility. Things are wild. But when they get narrow and squeeze in tight, the river is calm. That's consolidation. And often, that's the quiet before the storm. And if you see the price just glued to that upper band, that's pure buying momentum. So you get this incredible snapshot of volatility, trend, and momentum all in one glance. Okay, so let's dig into the strategy that this whole thing was originally built for. It's the classic breakout strategy. The philosophy here is buy high, sell higher. It's pure trend following. The idea is super straightforward. When the price breaks above the top band, making a new high, you buy. When it breaks below the bottom band, a new low, you sell or short. Donchian himself actually offered up two main flavors of this strategy. First, you had the 20-day system. This one's quicker, more nimble. It's designed to catch those shorter-term trends and faster breakouts. Then there was the 55-day system. This one is the slow and steady workhorse. Its job is to ignore all the little market noise and only key in on those really big, sustained, long-term trends.
And let's be clear, this classic approach could be ridiculously effective. Just look at this number. A system based on these exact principles, famously taught to the legendary turtle traders, pulled in an incredible 57.2% compound annual return. That's a huge number. And this was tested on things like commodities and currencies.
But, and this is a big but, here's where things get really interesting. That amazing performance we just saw, that was in markets like commodities and currencies. So the big question is, does that same logic work for a totally different animal, the stock market? This is really the critical question, right? Do stocks behave the same way? Do they have those long, smooth, sustained trends that a buy high, sell higher strategy needs to thrive? Or is their personality completely different?
Well, the data speaks for itself. And honestly, it might not be what you expect. Check this out. When you backtest the classic buy the breakout strategy on the S&P 500, going all the way back to 1960, it actually underperformed just buying and holding the index. We're talking about a 4.57% annual return compared to over 7% for just sitting on your hands. Ouch. And this, right here, is the modern twist. This is what's so fascinating. It's like the Donchian Channel has a split personality. For commodities and Forex, it's a trend-following beast. But for stocks tend to be mean reverting. That's just a fancy way of saying they like to snap back to their average price. So for stocks, it looks like we need to flip the entire strategy on its head.
Yep, you heard that right. For stocks, the data suggests doing the complete opposite of what Donchian intended. Instead of buying strength when price breaks out to a new high, the better strategy seems to be buying weakness, buying when the price breaks below that lower band and basically betting that it's going to snap back up towards the middle. And when you look at the numbers for this counterintuitive strategy, they're pretty compelling. A backtest showed an annual return of 9.16%. That's basically the same as buy and hold, which is great. But here's the kicker. It did it with much smaller drawdowns. That means less gut-wrenching volatility along the way, which is a huge win.
Okay, so let's put all this together. We've got these two totally opposite ideas. So how do we use this one tool in a smart, practical way? How do we build a framework around it, knowing that the right way to use it completely depends on the market you're looking at? All right, one of the biggest headaches with any breakout strategy is the dreaded false breakout, or head fake. So how do you filter those out? Well, you can add a few extra rules. For one, look for a big spike in volume on the breakout. That's a good sign of conviction. You could also use another indicator, something like the ADX, to make sure there's a real trend powering the move. Or you can use a buffer. Basically, you wait for the price to move a little bit further just to confirm it's the real deal.
Of course, picking the right period length is also a huge piece of the puzzle. It's not one size fits all. A 20 period might be perfect for a day trader, but a long-term position trader might be looking at a 55 or even a 100 period channel. But it's not just about your trading style. You've got to adapt to the market itself. If things are going crazy and volatility is high, you might want a shorter period to be more responsive. If the market is sleepy and quiet, a longer period can help you filter out all the meaningless wiggles.
You know, when you step back and look at all this, it's pretty amazing that a 60-year-old tool can still teach us so much. It shows us that maybe the most important thing isn't having the fanciest, most complicated indicator on our charts. Maybe it's about deeply understanding the personality of the market we're trading. And that leaves us with a final question to chew on. It's not just about whether the simplest tool is the most powerful. It's about whether we're taking the time to truly understand the tools we already have.